Hey traders, Jason here from Levitt Brothers. So in this video, I'm going to offer reasons to be optimistic about the stock market over the next 9 to 12 months, the rest of the year. Okay, when you look at 70 plus years of data, you can start crunching some numbers, and you can like model some movements in the market. And when you get a lot of models that start all pointing in the same direction, there's reason to be a little bit optimistic. Okay, some quant studies are a little bit far-fetched. Others are actually pretty darn good. You know, when a scenario plays out, 25 times over the course of history, and 95% of the time the market has done a certain thing, like that type of thing is worth listening to. So in this video, I'm just going to run through a handful of studies that have been done, just to kind of point to the, higher than normal odds that the market's going to do well for the rest of the year. All right, let's get started. All right, so number one, it is rare for the market to post losses in consecutive years. In fact, it's only happened twice since World War II. It happened after the dot-com bubble burst, and it happened in the 70s. Otherwise, over the last over the last 80 or so years, the market has posted a loss in consecutive years only 2 times. Last year, it posted a pretty big loss. The S&P dropped about almost 20%. So just purely based on this, since it's very rare for the market to post back-to-back losses, odds are a little bit higher than it posts a gain next year. Next, since 1950, the market has averaged a 16.9% drop from high to low during midterm years. 1 year after a low was put in place, the market was up every single time with an average gain of 32%. So if the October low was the low, we have a lot more upside to go. First of all, we have a good chance of holding the current gains, and number two is we probably have a lot more upside to go if indeed the October low holds. Next up, the market always posts big gains after corrections, which are 10%, and after bear markets, which are 20%. Okay, when it's darkest out there, when news is bearish, when stocks are trending down, when it's pretty painful, the reality is the biggest up moves take place immediately after the big down moves. And since 2022 was a big down move, odds are that not only will the market bounce this year in 2023, but it'll bounce big. Next up, year 3 of the presidential cycle is the strongest, with an average success rate of 89% and an average gain of 16.18%, which is more than double the next best year. So of the 4 years of the presidential cycle, year 3 is the best. We are in year 3. Odds are almost 90%. Historically, 90% of these years have been up, and the gains have been double any other year of the presidential cycle. Next up, October and November each gained more than 5%. Bounces within bear markets are normal, but back-to-back up 5% months are not. Since 1950, it's happened only 13 times. In each case, the market posted a gain 12 months out, with an average move of 22.2%. Also, October and November combined for a 13.8% gain. Since 1950, there have been 13 other such occurrences. 1 year later, the S&P was up 12 of those 13 times by an average of 20.7%. Next, at the end of November, the S&P closed above its 200-day moving average. Since 1950, there have been 13 times the index traded below the 200 for more than 6 months and then closed above it. In 12 of those 13 instances, the S&P was up 6 and 12 months later, with an average gain of 12.2 and 18.8%. Next, Steve Deppie's 2 and 10% price thrust reversal. It's when the market rallies 10% the prior 2 months while the trailing 6 months are down. 6 and 12 months later, there are no instances of a down market. This did trigger back in the fall months. The recent thrust in the advanced decline line and advanced decline volume numbers bodes well for the market when looking out 6 and 12 months. For example, Walter Deemer's BAM indicator, which is when the 10-day AD line is greater than 1.97, was recently 2.1. Okay, 6 months later, the market gained an average of 16% and has never been lower. 12 months later, the average gain was 20%, with a win rate of 23 out of 24. A couple more here. We are in the heart of the strongest 6-month period of the year. The yield on the 10-year has dropped from 4.3% down to 3.4%. Since topping in October, the market sees lower rates in our future, even if they're moving up now. This will offer a little bit of a tailwind. And finally, the dollar has dropped from 114 to 102, which has been trending lower for 3+ months. In fact, the 50-day moving average of the dollar recently closed below the 200. Looking out 6 and 12 months, the market has been up 85% of the time. Okay, so there's a lot of quant studies, and as I've said at the top, some of them are kind of out there. But when you do a quant study, and when history says that the market is based on a set of circumstances, the market is like 90-95% chance of moving up with a solid gain, it's worth listening to. As bad as the news can be, as much as people are predicting a recession, quant studies, which kind of ignore all the noise and just go with the straight numbers, point towards a pretty good market for 2023 and into early 2024. Now, this doesn't tell us what the path is going to be. The market could drop hard in the spring and then rally back, and it could, and therefore satisfy a lot of these quant studies. We don't know what the path is, but odds favor a pretty good market looking out. All right, hope you got something out of this, and I'll see you next time.